Like many other professional careers, the stock market is player versus player. And I found out that if you want to be a successful day trader, then the first thing you have to do is identify who the players are. So let's identify the players, starting with us. You and I, we are known as the retail traders, and we are the small players in this game. The medium-sized players are known as the prop firms, and they usually have a team of traders, and they supply them with capital to trade with. Now these guys are paid a percentage of their winnings, but they can have, for example, 50 to 100 million of capital to work with. Now the big players are just that, the big players, the hedge funds, the banks. We're talking billions of dollars under management to trade with. And it's the big players buying and selling that's really moving the market. Not me and you with our 100 shares or our 100 contracts. No, it's the hedge funds and the banks that's moving the market. And I found out as a beginner trader that if you want to be successful, you got to trade like the hedge funds. And it's simply the bottom line. And the hedge fund only cares about money. Getting the best price is the only objective. And we, you and I, we only buy when the hedge fund tells us to buy. And we only sell when the hedge fund tells us to sell. Whenever the buyers and sellers have an agreement in price and volume of shares traded, this creates a zone, either a supply zone or a demand zone. Now, I would like to show you how to identify and then draw a supply and demand zone. Now, I used a 5-minute chart to draw my supply and demand zone. To me, if you're using a higher time frame, that's support and resistance. Now, we like to draw them also, but supply and demand zone come from the intraday 5-minute chart. Now, supply zones we will identify with a red rectangle, and demand zones we will use a greenish color rectangle. Now, normally I like to wait and see what comes first, the higher day zone or a lower day zone, to potentially create a supply or demand zone. Now, in this example, a supply zone was created first. And remember, a zone is an area on the chart where buyers and sellers are in agreement of price. And you first see this here. We have an uptrend, and at this point, this is the high of the day zone. And we have an agreement right here between buyers and sellers. And the agreement between them is that the stock is currently not worth more than this price, and then they decide to push it back down. So let's go ahead and identify that price, that zone. This would be the zone, and I like to use a 10-cent range in creating the zone. So the zone was created here, and then you see the push down. You see the retest of the zone again, and the agreement was that the price, that the stock was not worth more than this price, and so the push was back down. And the secret sauce is, once a zone has been created, for you to wait for the retest and then take the trade out of the zone, either for a reversal or for a continuation. And so now, after the supply zone has been created based off the high price of the day, we're now looking for a demand zone to be created intraday, and we see that here. Initially, this is our first low area of the day, and this will be our demand zone for this example. So we're going to go ahead and take this and move this right here, and this will be our demand zone. Okay, This is our demand zone now. So now we have a supply zone and a demand zone. As you can see, the stock came up, created the zone, came out of the zone, went back to the zone for the retest, and then the final push out of the zone to create a demand zone. And again, this demand zone is an agreement between the buyers and the sellers that this area indicating a lower number of shares and a lower price. And the agreement is that the stock is not worth any less than this amount. And once that was identified, it was pushed back up. The price was pushed back up. So let me go ahead and give you an indicator, clear indicator here. Is that agreements in price, as well as here. Is it also that agreements in price? Here as well is the agreements in price to create the zone, and this was the zone being tested again, where you could potentially have entered for a put. Use the back of the zone, the closing, not the wick, but the candle body closing outside of the zone for your stop. The stock comes out this morning, trades up, creates a supply zone. Once the supply zone was created from the agreements of price between buyers and sellers, that the price is not worth any more than this, and after that they agreed to push the price down. The secret sauce was in the retest of that zone again, taking the trade out of the zone for a reversal. It could have been a continuation going up, or it could have went sideways, but taking the trade once it reaches this zone is a solid bet. Also, using the close of a body candle on the outside of the zone is where your stop area would be. But identifying the retest of the zone with the push out of the zone is where you would have taken your put, coming down to a demand zone. Once the demand zone was created from buyers and sellers, this was an agreement that the stock is not worth anything less than this amount, and they decided to push it back up. And the secret sauce was, once this zone was created, the retest, and then to take the trade out of the zone back to supply. What a beautiful, beautiful trade. Again, the stock goes a little further out of supply, comes back into our zone. Once you have the close of the body candle in our zone, this is an opportunity to take another put, to take the put coming out of the zone, using a close of a body candle above the zone for your stop, to take the put right back down to the demand zone. Once we hit the demand zone here, again, we have another agreement in price between the buyers and sellers. The stock is not worth any less than this, and they push it out. We have another retest of that zone, and then we have another push back to supply where profits could have been taken. This is just simply a beautiful example. Okay, now on this example, this is another day. I want to go through it again with you guys. So we open the day up, the market goes up, and then right away we have an agreement in price between the buyers and sellers to create a supply zone, and then right away we have an agreement in price to create a demand zone. So let's go ahead and grab that and put that supply zone here. Okay, and let's grab a demand zone here. All right, and circle the trades so you can see the trades here very clearly. The market opens up, we have an agreement between buyers and sellers, a supply zone is created, we then have a push out of the supply zone. This would be your first trade. Here, using this here as a stop area. If the stock price comes and closes above the supply zone, stop out. You take the trade all the way down to demand. The demand zone was created, okay? This is where you can stop out. This is where you can take your profits, not stop out, take your profits from the put, okay? Very easily, you can take your profits here from the put once this zone was created, and that would be along here, okay? It comes out of the demand zone, comes back to it to retest it, comes out of it again. This is where you take your call. Here. Coming out of the demand zone. If you want further confirmation, you wait for trading above, creating a new 5-minute high. That's your confirmation. Going back to supply to take your profits here. Back in the supply zone. The stock then breaks out of the supply zone. What do you do now? You identify that it has broken out and you establish where it has broken out. And that's here. So now you have a new supply area. The stock comes out of the supply area, goes back to retest it, push out again. This is where you have a put. Here with, okay, your stop being a close above the supply zone here. Anywhere up here is your stop out area. The closer you are to it, the less your risk, the more the reward. So the closer you are again to entering at the zone, the smaller your risk, the greater your reward. This is where you take your put, coming down. First profit will probably be VWAP. Second profit area would be demand. So again, you can take profits here realistically because the stock could hit VWAP and turn around and bounce back. But in this case, it continued. So this is where your other piece will be taken off at here. Now the stock hits demand, pushes out of demand, comes back, retests demand. This is where you take your call, okay? You can take your call anywhere in this wick, or you can take it here with the confirmation of it breaking out of the zone. Yes, it's a little far from the zone, but with this huge wick, that's a very good bullish sign. Very good bullish sign. So this is where you would take your call and take your profits at supply. That's where you take your profits at supply. The stock then comes out of supply, goes back to supply to retest it again. This is where you would take your put, coming back out of supply yet again. Taking your first profit target here at VWAP, as we stated before, here, because it could hit VWAP and turn around, and it did just that here on this example. So you would stop out here and not lose anything. You would get a half a gain here, stop out here. What takes place now? A new level has been agreed. But before anything can happen, another level has been agreed. So really all of this is sideways action, okay? It's sideways action, okay? We can still acknowledge it though, however, and then later on in the day, the stock comes out, breaks above it, okay? Comes back down to it, and we have more sideways action than a day. But nonetheless, we had a lot of great trades on this day as well, following that example. Don't want to be too long, but this was a perfect example of how to use the supply and demand intraday off the 5-minute chart with calls and puts.